Every generation creates companies that become so deeply embedded in our lives that we stop noticing them. Google became where we search for answers. Amazon became where we shop. Visa became the invisible network moving trillions of dollars every year. Banks are no different. Most people never think about the institutions holding their salaries, financing businesses, or approving mortgages. They are simply expected to work. But every so often, a deal reminds us that banks aren't just places to store money. In 2026, South Africa's Nedbank announced plans to acquire a controlling 66% stake in Kenya's NCBA Group for nearly $900 million. At first glance, it looked like another corporate acquisition. But Nedbank wasn't buying a struggling bank. It wasn't even buying market share. It was buying one of Africa's most advanced digital banking ecosystems. A bank that financed businesses. A bank that powered millions of mobile loans. A bank that had quietly become one of the most influential financial institutions in East Africa. The question is, why? Why spend almost $1 billion on a Kenyan bank? Why not build those capabilities from scratch? The answer begins long before smartphones, long before mobile money, and long before NCBA even existed. It begins with a problem. In 1959, Kenya's economy was growing. Construction companies needed machinery, farmers needed tractors, transport companies needed trucks, but very few businesses could afford to buy those assets outright. Traditional banks preferred short-term trade finance. Lending millions to buy a fleet of trucks seemed too risky, so most banks simply said no. Then a company called National Industrial Credit, later known as NIC, saw something everyone else had missed. Instead of treating machinery as the risk, it treated the machinery as the security. If a transport company borrowed money to buy trucks, those trucks became the collateral. It was a remarkably simple idea, but it changed everything. While NIC was building the physical economy, another bank was preparing to transform the digital one. The Commercial Bank of Africa, or CBA, focused on large corporations and wealthy clients. But by the early 2000s, millions of Kenyans owned mobile phones, yet very few had bank accounts. Then in 2007, Safaricom launched M-Pesa. It transformed how millions moved money. But M-Pesa had one limitation. It couldn't function as a bank. You couldn't build savings, earn interest, or easily borrow money. That's where CBA saw an opportunity. In 2012, CBA partnered with Safaricom to launch M-Shwari, one of the world's first fully mobile banking services. Customers could open a savings account and apply for small loans directly from their phones. Overnight, CBA went from serving thousands of corporate clients to reaching millions of ordinary Kenyans. By the end of the 2010s, success in banking was measured by who could combine technology with trust. In 2019, NIC and CBA merged to create NCBA Group. NIC brought decades of expertise in corporate banking and asset finance. CBA brought millions of digital customers. Together, they became far more valuable than either bank could have been alone. Which brings us back to the original question. Why would Nedbank spend nearly $900 million to buy it? Because building what NCBA had created from scratch would have been far more expensive. You need banking licenses, technology, employees, branches, and millions of retail customers. Most importantly, you need trust. And trust has to be earned over decades. NCBA had already done that work. On paper, Nedbank bought a bank. But in reality, it bought decades of trust, millions of customer relationships, a proven digital ecosystem, and perhaps the fastest route into the future of African banking. Because in the end, the most valuable asset a bank owns isn't the money inside its vaults. It's the place it occupies in people's everyday